Good morning, everybody, and welcome to this final BDO corporate reporting webinar for 2022. Demystifying financial instruments. We've left the best for last, which is one of the more complicated topics, and it was also a bit of a test to see how many of you were really committed to the concept of reporting webinars, because it's only the diehards who are going to attend today, and we're really looking forward to doing this with you. I've got with me today Etienne Gouws once again. Welcome, Etienne, to this session. Nice to see you again.
Thank you, Kevin, good morning, everyone on the webinar. You may remember that the last time when Kevin and I presented together, we had some very interesting technology issues, some might say. And you know what, based on the messages that I've been receiving on my phone from my so-called friends, I really hope that today the technology holds up and we get through this in one piece. I won't be able to stomach it again.
All right. Well, we've built some contingencies in if it happens again, which basically means we haven't really thought about it, and we'll see what happens when we get there. But we hope you enjoy the session today. It is the last session today, and let's just have a look at the quick agenda of what we're going to be covering. Etienne's going to start off in a couple of moments to actually talk about why we need to talk about financial instruments. Now, I'm looking forward to that because I want to see what his messaging is. I know what his messaging is, but it'll be really interesting to set the context of why we're looking at this topic again and introducing the concept of how we're going to try and demystify it for you. It's not an easy topic, and so we're going to try and keep it simple and give you the tools you need to head into 2023 a little bit more prepared for financial instruments. We'll then move into steps that may assist with the accounting, and that'll be broken up into a couple of categories. Etienne and I will go through a couple of sections there and give you some examples, and then we'll do special considerations in terms of derivatives and hedging and some other complexities. We couldn't do a financial instrument session without dealing with those special considerations. That'll be our parting gift for you in the lead up to the shutdown. We will also close with our traditional BDO resources where you can get assistance, and also we'll take you through next year's webinar topics that we've already put out for 2023 so that you can start registering for those sessions. So I think with that, shall we get into it, Etienne?
Yeah, thank you, Kevin.
Right, so why we need to talk about financial instruments? Etienne, you're on.
Well, that is a great question, and ladies and gentlemen, you might all be asking yourself exactly the same question. Why would BDO put financial instruments as a topic as the last webinar before Christmas? And then on top of that, what is this business about demystifying financial instruments? So in answering those questions, I thought what I may do is put a few terms that are, let's say, related to financial instruments on the slide, and I'd like you to think about how you feel about them. Do you feel that it's the same as having maybe watched a bit of a Christmas movie, a really feel-good situation, or is this closer to Halloween? I mean, let's take embedded derivatives as an example. I mean, it's a predictable ending, let's be honest. It's not always a good ending, but it certainly is a predictable ending. The terms you see on the screen at the moment are all terms that come from financial instruments. SPPI is always a good one. So when you see these terms, you may feel, well, no big deal. You've been accounting for financial instruments for quite a long time. You're getting it right. There's no issue with this at all. Now, having said that, there's probably a chance that some of you may have the same reaction as some of the preparers that we actually talk to. When we speak to preparers about financial instruments, the overwhelming comment that comes out of this is financial instruments are complex. And we also see that some of the requirements are unclear. There's a lot of judgment involved. Seems as if there are some inconsistencies about measuring some items at fair value and some at cost, and when do we do what? Embedded derivatives comes up quite often. Kevin will talk a little bit about derivatives later today. There's some measurement issues that arose, loan receivables that in the old world we didn't really have to think about, all of a sudden may have to be at fair value. And hedging is always a good topic. What I would say about all of this is, I'll take it back to the very first comment. Financial instruments are definitely complex. We don't dispute that for 1 second. There's a really good reason why accounting firms have financial instrument experts looking after the clients and the issues and the implementation matters that actually arise as part of financial instruments accounting. But if you are not an expert, but you are still required to prepare financial statements, what we're hoping to do in this session today is give you that big picture, the big picture view of what financial instruments are and how they fit together, so that when you are confronted with a significant issue or a matter that you need to consider, you may know where to go and look for the bits and pieces, and then, if you needed to, ask for help. So Kevin, on the next slide, please. What we put together was 4 steps. Now, a few disclaimers before we carry on. You won't find these 4 steps in an accounting standard. These are just the steps that Kevin and I came up with to think about the big picture, call it, if you will, guardrails as to what you may need to do to think about accounting for for financial instruments. I would not say that we're going to go into the nth degree of detail. So if you're looking to write the financial instruments exam after this, I would do a bit of further study. But I do think it will give you the big picture view. It is interesting, and you probably know this by now, but it's important to call out maybe that there's not necessarily a one-stop shop for financial instruments. We have 3 accounting standards dealing with financial instruments, and it is important to understand which accounting standard applies to which part we're trying to address. So I'll kick off with the identification piece. Kevin will go through classification and measurement, and then I'll touch on disclosure again. So Kevin, with the next step, please. So again, going back to my disclaimer, these for the absolute purists on the webinar, this is not exactly what you'll see in AASB 132, but what I'm hoping this will do is give you, again, that high level view. In thinking about financial instruments, the starting point is probably what are they not? What would be excluded from the scope? And on the left-hand side, you see that investments in subsidiaries, joint ventures, and associates are excluded. So it's important to note that in the usual run-of-the-mill way, an investment in a share, an equity investment that we hold, would be a financial instrument. But the moment that that equity instrument provides us with control over the subsidiary, joint control over the joint venture, or significant influence over the associate, we're in different standards. And as a general rule, it doesn't apply. Employee benefit plans, on the face of it, will require some payments to be made at some point in time. As you would know, IAS 19, very detailed in terms of accounting for that, so thankfully scoped out of financial instruments as well. Insurance contracts, definitely scoped out. That's a good thing in my view. Share-based payment transactions, again, if you know IFRS 2 well, you'll know that there are some equity settled and some cash settled arrangements. And it's clear that the cash settled arrangements and even the equity settled arrangements are accounted for in terms of IFRS 2 as opposed to IAS 32, i.e. as a financial instrument. Executive contract is worthwhile calling out. You may think that this is an obvious area. Sometimes when you look at an arrangement you have, you may say, well, there seems to be a contractual obligation to make a payment. And somehow I don't have the ability to get out of it. So do I have a financial liability as an example? Well, it's clear that if the other party hasn't delivered to the extent that it has to deliver, that you would be outside of the scope. So we won't be recognizing liabilities in advance of actually receiving goods or services, which may sound very easy, but in some instances could be complex. So if we know what they're not, what are they? And in my mind, the 3 categories that we often look at would be financial assets, financial liabilities, and equity. And as a starting point, we already talked about equity instruments, but other types of financial assets would actually be cash, or the right, contractual right that is, to receive cash. A liability would be the obligation to pay cash, and an equity instrument in its purest form is an ordinary share. You're entitled, the holder, or the holder is entitled to a bit of net assets of the company when it's wound up. So that's not, unfortunately, where it stops, but without going into too much further detail, I will say a few other things. Kevin will deal with derivatives a bit later, but there are some other items that you should be aware of that could be either an asset, a liability, or even equity. depending upon whether they're favorable or unfavorable, whether they have conditions and terms that are attached to them that would put them into one of those categories. So take away from this slide, what is excluded? Think about your arrangements as financial assets, financial liabilities, or equity. Remember that derivatives could be any of those. And when you are settling any arrangement in your own equity instruments, that becomes quite interesting. And I would suggest that perhaps you seek consultation if you end up in a situation such as that. With that, I'll hand over to Kevin for step 2.
Thanks, Etienne. And looking at that, it's probably the simplest definition slide I've ever seen for financial instruments, but Etienne has managed to capture in there really some of the key things to look for, things like obligations and rights. So that's speaking contracts, and cash all over the place. I like that. And of course, then equity. So that's a good summary of it. Moving into classifying financial assets, I think the big thing to make the transition from Etienne's slide to the next slide, which is classifying, is that at this point, before you transition to classifying, the realization will have dawned that you have one of these things. So that was like the key takeaway for me in Etienne's slide, is the identification that you actually have a financial instrument contract, which is then either going to be a financial asset, a financial liability, or equity, depending on the rights, the obligations, and the terms attaching. In keeping with the big picture look at these things going forward, when I'm going to talk about classifying financial assets, I could easily get into a full day session just on business models and cash flow types and all sorts of things here, because there are complicated rules in the standard about classifying financial assets. But the big picture, standing back, is to actually say to yourself, once I've got the contract and I know it's either a financial asset, financial liability, or equity, the question then is, how am I going to classify it on my balance sheet, which leads to how am I going to account for movements in its value or its cash flows going forward? That's really what you're trying to do here. Now, the simple way of looking at it, and I'm starting with financial assets here first, because there's different rules and different classifications for equities, liability, and assets. But if we start with financial assets, there are really 4 types of classification. And if you really want to break that down, it's driven more by how you actually measure it going forward, and then how do you account for movements and changes after it. There's really only 2 categories. The 2 categories are amortized cost and fair value. Fair value requires evaluation, and it'll require evaluation sometimes at initial recognition, but at least at reporting period ends. And then amortized cost, I mean, is your base category in a way for your traditional type receivables, things where you're going to collect cash, maybe earn some interest to, factor in credit risk from the counterparty, your sort of debt instruments, or your traditional debt instruments. But really, helicopter view, big picture view is, once you've identified you've got a financial asset, a contractual right to receive cash, you've got to put that on your balance sheet in some form or another. It's either going to be carried and classified and measured at amortized cost or at fair value under those 2 categories. And then the way you account for movements in or changes in value or interest or other elements of changes in profit and loss are either through comprehensive income or profit and loss going forward. Look, I mean, the other way to look at this is really to say base debt instruments that are supposedly made up solely of principal and interest, which are held to collect. In other words, your traditional receivables and your loans will really be the only category that are sitting at amortized cost, whereas every other type of financial asset now is really measured at fair value in some way or another. On the liability side, it's even simpler. Here, we generally start with fair value and move to amortized cost as a residual category, but you'll generally get the feel already where I'm going with this. Is financial liabilities, similar to financial assets, are either carried at a fair value measure or at an amortized cost measure going forward. So once you have a financial liability, it's to work out which of those are you in, classify it accordingly, and then set up your policies and your practices going forward. Your trade payables, bank borrowings, and loans and payables, similar to receivables and cash and bank and loans receivables, are generally at amortized cost, almost like your traditional receivables and your traditional liabilities, whereas really everything else that has some sort of complexity that drives either value or drives either changes in cash flows, those are all going to be at fair value. And if you really stand back again and think about it on a big picture point of view, that's what this is trying to capture. When you invest in financial assets or you have obligations in liabilities that are traditional funding or receivables or funding instruments, you're going to account for those the traditional way, amortize cost, put them on the balance sheet, gross them up for changes in interest, and reduce them when you make payments or receive payments. The moment you start to introduce value changes into these things or complex type terms and conditions that change the value or change the potential cash flows in those instruments, you're probably going to end up in a fair value type category. And that's maybe the simple way to think of it. I must deal with impairment because no presentation on financial assets and financial liabilities and equity would be complete without some mention on impairment. So impairment generally impacts the categories that are measured at amortized cost, which means you're carrying your traditional type receivables, financial assets, that are held to collect instruments where you're going to hold on to them and collect the cash from the debtor. We do need to put some sort of impairment to those days when there is impairment, because traditionally under all accounting, when you're using cost measurement basis, you have to impair it. This is the concept of recoverable amount, which is really applied across the board for all assets that are carried at cost in accounting. It's the same with financial assets. We need to recognize impairment on these things. I could spend a whole day on this as well, and I'm not really going to get into the staging assessment, but the reality of financial assets is all financial assets that are carried at amortized costs, those are traditional receivables and loans receivables, they all have a risk that the debtor won't pay or can't pay because of a credit event. And you would need to put or measure some sort of impairment loss allowance against those using the staging assessment in IFRS. I'll leave it at that because today isn't about getting into the detail, it's about big picture. So hopping on to the next slide then, once you've classified your financial receivable, you would then count for those things on an ongoing basis. And what you would do is every reporting period, account for your amortized cost effective interest or measure your instruments at fair value and then reach for disclosure. Etienne, you're going to cover disclosure for us.
Yes, thank you, Kevin. So AASB 7 is the standard that deals with disclosure, and I think there's good news and there's bad news. The good news is that it's very prescriptive, and the hard work has really been done in the previous stages. So if you've worked out that you have a financial instrument, you've categorized that, as Kevin has indicated, as either fair value or through P&L, OCI, or amortized cost, you know how to measure it, then you could have done all that hard work, and if you get the disclosure wrong, then some might say that it's not worth much because what you represent in your financial statements that is public facing is what you need to live by, if you like. So I look at AASB 7 as two parts. The one is looking at the significance of what the financial instruments are, and that's listed as an objective as well. This is really just the usual suspect. We're looking here at assets and liabilities that are classified at amortized cost or at fair value through profit and loss, etc. And you have to show them on the face of the balance sheet or the notes. So far, so good, pretty easy. You'd also expect to see the movements in the operating statement or the P&L. So income, expense, gains and losses, you'd expect to see them. And as Kevin has indicated, allowance for credit losses need to be incorporated as well. Watch out for some additional disclosures, things like offsetting, if you have reclassification of financial instruments, defaults and breaches sometimes catches out, and then the usual other ones. Hedge accounting, again, we'll touch on a bit later, but put a bit of a reminder that if you do hedging, make sure that you comply with the requirements. The right-hand side of the slide really deals with the disclosure that we're not and we haven't been used to up to the introduction of AASB 7. because they relate to risk and not so much to the assets and the liabilities and the income and expense that we see on the primary statement or in the notes to the financial statements. So they really deal with how the entity identifies the risk that comes from financial instruments, how they manage it, and how they measure it. You've all been preparing financial statements for the last few years, so this is not news to you, but it's worthwhile just to reiterate that there is an issue with ensuring that the risk procedures that you employ are the risk procedures and management that you include in your financial statements. Over the years, the financial statements, the illustrative financial statements of all of the firms have really been good at making sure we tick the boxes in terms of the disclosure. But sometimes we do see that it looks a bit generic in the way in which we say we manage risk, and this is your opportunity to really bring to the fore the really good risk management procedures that you employ and ensure that that gets recorded in the financial statements. With that, I think we're moving on to special considerations, Kevin.
Thanks, Etienne, for that. And it's also, once again, listening as Etienne was talking, I couldn't help but think that Etienne and I have the same value set when it comes to what disclosures are about, especially when it comes to financial instruments. I like his comment about this is your opportunity to essentially write down your story, because that's what this is. It's telling your users how you actually look at these risks and how you actually manage these instruments. At the end of the day, instruments are all an enablement to conduct business. This is all about cash, whether it's received or owed, and then value in terms of assets that you deploy. And I do want to tell one little anecdote here, is that last night I have some guests staying with me at the moment, and we played Monopoly, and I couldn't help but thinking that I was actually playing a financial instrument game. You know, it was all about cash, value, how you actually manage the value and play the game. And that's then where your disclosures come in. You can tell your story. So think about that when you're drafting your financials. How would you explain the game of Monopoly that you're playing to your users? On that, I'll move to special considerations and complex financial instruments. We have to deal with this. This is the complexities of the standards when it comes to derivatives and then hedging. And Etienne's going to deal with hedging after this. No presentation would be complete on financial instruments if it wasn't for derivatives. It strikes fear into the heart of every accounting student in the world, and then sets them up for business right up to CFO, because I don't think anybody ever gets rid of the fear of what a derivative is when it comes to accounting. So what I've tried to do is actually take the concept of derivative and break it down into some simple components. A bit of a disclaimer here again, this is a big picture presentation. So I have not put all the definitions on the screens, and I won't talk about them. What I'm going to talk about today is the things to look for that can help you identify whether you potentially have a derivative. If you find that you've got a derivative, then it may need to be accounted for separately or in some way, and you also may need some specialist assistance when you get there. But the first step is identifying that you have them. And so if the only thing I can get across in today's section is I have a derivative, or potentially I have a derivative, now what do I do with that? Then I'll achieve my objective today. So let's talk about what the derivatives are. There are really two types of derivatives we run into. Once again, more complexity than what I'm actually letting on. But the two main ones we run into, or the two types of derivatives that that we run into, which are located in different places, shall we say, are the whole derivative. So the whole instrument is a derivative, and sometimes on the right-hand side we actually have derivatives that are embedded in other types of contracts, the so-called embedded derivative. But let's talk about what a derivative is. At its core, a derivative is a feature of a contract, of a financial instrument, where the value changes in response to an underlying. And the best one is probably the example on the right-hand side, on the left-hand side in the top corner for the examples, investments in shares in listed or unlisted companies. I mean, it's a simple equity instrument. You would have identified that as I've got a shareholding, another entity holds some shares, and its value changes in response to, let's say, the market price or the share price of that company. That is your base type of derivative. The embedded derivative is when you take that sort of value feature and you embed it into some other type of financial instrument contract, the so-called host contract or the non-derivative host contract. And one of the features to look for with embedded derivatives is that it has the effect of changing the cash flows in that combined instrument. Now, these are the difficult ones to spot. Embedded derivatives are the difficult ones to spot, and that's why I've put these two definitions on the screen, because if you're looking for the potential that a derivative exists, you want to look for the things that it does. On the left-hand side, if you've got a derivative contract, the value will change in response to some sort of underlying, whether that be commodity price, foreign exchange rate, and so forth. Whereas an embedded derivative, the feature you're looking for is the same value change, but it has the impact that it might change the cash flows of the contract that it's embedded in. Now, I've put some examples at the bottom. I've spoken about investments in shares, but we talk about interest rate swaps, commodity futures and options. Those are great examples of derivatives where the value of that instrument changes because of an underlying. We take the interest rate swap, you enter into a contract with the bank, maybe you've got a loan with a variable interest rate and you want to fix that interest rate. So this is essentially a risk instrument. This will go back to Etienne's disclosure section before, where you would talk about interest rate swaps in the context of how you're managing risk and how you're managing interest rate risks. So if you're dealing with interest rate swaps, you're clearly trying to manage that sort of risk, and you want to tell your users about it in the disclosure section. But the interest rate swap is clearly something whose value changes as the interest rates change. So there's your derivative. Those two in the top line of my examples are good examples of derivatives that are just standalone derivative contracts. It's easy to see that there's an underlying market variable or some other type of rate or index that's changing the value. The ones at the bottom start to get a little bit more complicated. These are the ones, these three at the bottom: investments in convertible notes, accounts receivable based on profits or market index, and contingent receivables, where you start to have embedded derivatives. They look like host contracts that exhibit, shall we call it, normal financial asset or financial liability features. So let's take an investment in a convertible note. The convertible note, by its nature, is you've got a loan, or the company has a loan. It's got investors that put money in, so it's issued a debt instrument, a financial liability. It has to repay that, but it might not have to repay it in cash. It may have the option under various mechanisms to issue shares instead of repaying the cash. So there's your convertible note. The note converts to shares if the instrument isn't repaid. And I think it's easy to start to see how you break these into components, because if you repay the convertible note in cash, it then acts like a normal loan payable, which is or loan that's repaid. It sounds like a normal financial liability. It might even be recognized at amortized cost because it's a traditional loan instrument. But the feature that's embedded in it, which converts it to equity, that may be your embedded derivative. The value of that feature changes because of an underlying, something like the share price that is the equity, and it can change the cash flows of the combined instrument in a way, for example, that you actually can avoid paying any of the cash if you issue the shares. So there's the feature that changes the cash flows. And that's a good example. Accounts receivables based on a profit or market index. Also another example, you got a basic host debt type instrument. Somebody owes you money, normal receivable. You might recognize that at financial asset at amortized cost. You might even have some expected credit loss against it, because there's a risk they may not pay. But the amount of cash that they owe you may vary because of some underlying index, and that is the embedded derivative. It's changing value and so forth. I mean, we even have examples, and this is a way to think about it, is it's almost like a radar approach. Almost every financial asset or liability could have an embedded derivative in it, and many of them do. You can have a accounts receivable where somebody owes you, and they have the option to pay you early. If, for example, the interest rates are going to go up, they might pay you early to get out of the debt so that they're not exposed to interest rate variables. The prepayment option that allows them to pay early could be itself an embedded derivative, because there's a value change there. They can exercise the option to pay early in order to avoid, let's say, interest rate movements later on down the chain, there's the feature that changes the cash flows of the instrument. So there's embedded derivatives everywhere. The key here is not to get too concerned about the fact that every derivative needs to be accounted for separately. We're not going to talk about that much, that too much today, because derivative accounting beyond identifying it can get complex. Some of these are actually accounted for as part of the host instrument, but others are actually split out in terms of embedded derivatives and actually accounted for separately from the host instrument. We're not going to get into that today. As I said, the first part of this session was to actually identify that these exist, and
Kevin,
at least know you have a problem.
if I could give it just another example.
Yes.
You know, so my first in real life, obviously, my first introduction to complex embedded derivatives was in what no one expected to include embedded derivatives. I had a client that signed a contract with a supplier of some goods that they use in their manufacturing process. It's not quite just raw materials, but the supplier would effectively manufacture or produce my client's required goods for their manufacturing process. So on the face of it, it was a contract to buy what I'm going to refer to as just raw materials or stock. When you started looking at the contract, it said that the price of the contract is varied with changes in the labor market for that particular jurisdiction. It also changes with reference to changes in commodity prices that goes into it. There were 5 different mechanisms by which the price of our raw materials we're buying could actually be varied. And looking at what they were, we identified that there were quite a number of them that were embedded derivatives. And if you stand back again at that high level, you say, hang on, did I not agree a commercial contract with a supplier and the price I'm paying becomes equivalent to what one might argue is close to a market rate, or not quite fair value, but a market rate for it. To Kevin's point, the good thing about it was we didn't have to account for all of them separately, and so the subsequent measurement of the embedded derivatives was not as hard. But I want to highlight to you that even in contracts that you think is a simple buying of something or simple selling of something, when the price varies, just be on the lookout that there might be an embedded derivative lurking in there if it changes with reference to an underlying, in my example, it was the labor index.
And going to Etienne's point, it's a good example, Etienne, because interestingly, I came across one of those contracts quite recently. They're often embedded in government contracts, and Etienne has some expertise in the public sector, so I would be surprised if that's where you saw it, Etienne. But he's correct in terms of some of these indexes. I saw one recently where the market index that they were referring to was a labor index in another country. And that one introduces some complexity to the accounting, because now you've almost got double up of sort of risk exposure. Is why would you expose yourself to another labor market altogether in a different country? And that one did present some interesting concepts. And the reason why they did it was because it was in their interest in terms of their risk management strategy. So it brings it back to Etienne's disclosures section again, is if you actually think about how you run your business, how your risk strategies are outlined, why would you enter into a contract like that? It often drives the disclosure, but also you can then easily spot the derivative, because you would have taken that derivative out or entered into it knowing full well what it was going to do for whatever risk reason or reason that benefited the entity. So it all comes together at the end of the day. Thanks, Etienne. I'll jump across quickly. I've got a couple of slides in there which I won't get into about classifying these, only to say that most derivatives that are separated on the liability side from their host instrument, this is embedded derivatives, will be measured at fair value. And on the financial asset side, many of the same types of derivatives will actually make those financial assets be measured and classified at fair value as opposed to amortized cost, if they're not already at fair value as a financial asset. Okay, I am going to deal very quickly with complex financial instruments. Now, this is a variation of what we've been talking about up until this point. Because it's something we run into in terms of debt and equity. We have done countless webinars on this, and video's got a very good guide on how to take convertible notes, for example, and actually split them into their components for accounting. And the three types we generally have are compound financial instruments. Let's say we've got a convertible note, which could either be repaid in cash or settled with equity. That might be a compound instrument. That's the one that everyone gets trained on when they do accounting at university or when they get in their CA. The reality, though, is they only teach you that one because it's simple. The other ones are more complicated. So one of the biggest issues we run into in the advisory practice is that financial instruments that are, let's say, convertible notes that could have debt and equity components, they're often misclassified. If they are identified, they're misclassified as compound financial instruments because they're the only one that a lot of people know about. But you can have variations of that where you've got, let's say, a convertible note and it has a liability and a derivative liability component, not an equity component. So these are the different types of financial instruments that you can have on the compound instrument, on the convertible note side. So often these are liabilities and might have equity components or derivative liabilities, or as a third option, the whole thing's just a liability. So what I've done here is given some high level direction that you might follow if you are presented with, let's say, a convertible note. It's the simple one that we often run into that could have debt or equity features on the liability side. Short ask rule on this one is if you have to pay back cash that you cannot avoid, you've most likely got a liability component. That's an oversimplification of the problem, but it's a good feature to look for. If you've got some sort of instrument that you've entered into that appears to be debt on the liability side and it might have some equity features in it, if there's an obligation you cannot avoid to make some sort of cash payment, including, for example, interest payments on the debt, those cash payments are most likely a financial liability all by itself. And that will probably establish some sort of host debt instrument. Then you might have some sort of conversion features on top of that that may or may not be settled in shares, and the types of shares may or may not be variable or fixed. Those will drive whether you classify that conversion feature as equity or as a financial liability. Now, as I said, we're not going to focus too much on this today because we've done countless sessions on this, and we've got lots of help that's available on the video resourcing website. I will leave you as a self-study these three examples that take you through how do you apply the definitions for convertible notes, for example, into a compound financial instrument, a hybrid financial instrument, and just a pure liability financial instrument. Three examples with three different alternatives in terms of cash payments and then in conversion into shares, whether it be fixed or variable number of shares. The takeaway for this session is, do I have a contract that I have an obligation to either pay cash or settle shares, and how do I break that up? It's a complex part of accounting, but the thing you're looking for is, I need to pay cash in some form or another, there's your liability, and if I've got the ability or option or other way to settle this in shares, is it a variable number of shares or a fixed amount of shares, often drives whether you've got equity or derivative liability there. I think I'll leave it at that, because I think we've covered that before, just to leave you with this on complex financial instruments, which are often things like convertible notes. Don't be don't be lulled into a false sense of security that if you issue an instrument that could result in shares being issued by the company, that has to be equity. That is not how financial instruments work. Financial instruments are pretty much based on the rights and obligations in the contract. Lots of our clients and people come to us with, I've got this instrument. Yes, I might have to pay cash, but I'm planning to issue shares. The fact that you're planning to issue shares, but you might not be able to avoid the cash under certain scenarios, means that you actually need to account for that as an obligation. So instruments are not classified on what you think is going to happen or what you're planning to happen. It's based on their substance and what the rights and obligations dictate. The fact that an entity has no obligation to pay cash doesn't by itself mean that you don't have a financial liability. Even an instrument that could only be issued in or settled in shares could be a derivative liability. depending on how it's structured and how that obligation arises. Because in many cases, if you are settling a liability with shares, you're actually just settling a liability with shares. And sometimes a very simple instrument is you're using your shares as currency to issue the liability. It's still a liability because you have this obligation. On the left-hand side at the top, there's really a good way to look at these sort of complex instruments and actually ask yourself, if I've issued or the company has issued this sort of equity liability instrument, from the perspective of the existing equity holders, does this instrument put the holder in the same position as the equity instrument? Let's put it another way. If Etienne and I have a company with we're the two shareholders, we take out a loan with the bank, but we give the bank better rights over that loan and the settlement of shares over that loan, such that, let's say, the bank actually could end up with a bit of equity and dilutes our shareholding. It may be a liability because we've actually put ourselves as shareholders below the interests of the loan holder, and they may have rights to equity that puts them in a better position than we currently have as existing shareholders. That by itself could be a liability, and often that's a good way to think about it is, am I using my shares in such a way that I'm actually putting the existing holders of equity instruments in the same position or a worse off position? And that's probably could be a liability. All right. I think I'll leave it at that and say hedge accounting. Over to you, Etienne.
Oh dear. Thanks, Kevin. Look, it's lucky last, really, before we leave you with some closing remarks. If we agree that financial instruments as a topic is complex, then hedge accounting is one level higher, I think. But let's break it down again in the interest of simplicity and what we're trying to achieve here. What would economic hedging be, for instance, versus hedge accounting? And we do get the question often, should we hedge account? Well, the answer to that is almost always, it depends. And I'm hoping just again by lifting it up one level higher that you'll understand why I would say it depends. So if you do business, you are likely exposed to market and to economic risks, whether we like it or not. And of course, because we're dealing with financial instruments, we are talking about those kind of risks that relate to or arise from the equivalent of financial instruments and the things we do with them. So if you have, even if you have bank accounts, if you have loans, if you receive or pay interest, if you transact with a company that's outside of your jurisdiction in a different currency to yours, you will be exposed to some of those risks. Again, keeping it simple, and you may have heard this example quite a number of times. I'm going to use an example and then use that for the rest of the presentation. Let us pretend that we are buying a piece of equipment from an entity outside of our borders, and the transaction is in US dollars. Our functional currency is Australian dollars. As of today, we signed the contract. In about 6 months' time, we hope we'll receive that piece of equipment. Okay, that in itself exposes the company to exchange rate risks if we do nothing. So if the risk management strategy of your entity is to do nothing, you will be at the mercy of exchange rate movements between now and the day that you take delivery and have to make a payment to the foreign supplier. You may, as good business practice, you may choose, well, that's not something you want to do because potentially this is a transaction, the type of transaction that you do often. So maybe you get to the point where you say, let's do a forward. Let's do a forward contract. So you'll buy currency, the equivalent you need, in about 6 months' time. And as of today, as Kevin would have indicated before, and if you followed the movement and what a derivative would be, the value of that contract, that forward, will move with reference to underlying exchange rates. So it's a derivative. And if everything works well, then by the end of 6 months, the contract will mature, you'll get your US dollars, you'll settle the US dollars, and you would have had a fair bit of certainty about the amount of money to spend on the equipment. That's a risk management strategy. We haven't even talked about accounting yet. Let's go one level of accounting before we go to hedge accounting. The normal rule would be, as Kevin has indicated, that you've got the categories, fair value through profit and loss, etc., etc. Derivative, fair value through profit and loss. So every day between now and the required the required timing of making the payment, the 6 months, there would be a movement in the value of that contract. And that movement would need to be recorded in your P&L, and there'd be a derivative financial asset or financial liability on your balance sheet. Again, we haven't even touched on hedge accounting yet. So the question that you might then ask, well, okay, if none of that's hedge accounting, then what is it? Well, hedge accounting is a way of taking that volatility, so the movement in my exchange contract, my forward contract, taking that out of the P&L and putting it, in our example here, putting it into an equity reserve. And the aim of it would be to match the timing of when your exposure in the cash arises, which is when you need to make a payment to your foreign supplier, to when the contract matures. So if we achieve hedge accounting and we achieve it well and effectively, it would mean that you save the volatility in your P&L for the cash exposure that hasn't occurred as yet. So if that sounds good to you, that we may be able to take some of the volatility in the P&L out, your next question would be, well, why don't we just hedge account everything? And I'll answer that in two ways. The first one is to say that hedge accounting is a bit of an anomaly in the context of the normal rules. It's not necessarily intended to be accounted for in the way that hedge accounting prescribes. As I said, a derivative should be accounted for in the P&L. The movements in the derivative should be accounted for in the P&L. But hedge accounting allows you to bend the rules, if you like, and do a bit of a different accounting, I almost say trick, don't say trick, treatment to ensure that you get better matching. You would also then expect, and this is the second reason, that if we will allow an alternative treatment, that the criteria associated with that treatment needs to be quite strict. And sometimes when we explain what the hedging criteria would be to our clients, this is the point where they say, well, do we think that we really want to sign up for that? So Kevin, if you go to the next slide. Again, sorry, just going back one. Sorry, next slide. There we go. At a high level, again, those criteria that you need to achieve to be able to save the volatility in the P&L are the ones that you see in front of you. And again, very complex, but at the highest level, these are the things you need to be thinking about. The first one I'm going to talk about is formal designation and documentation. And this is where we basically start introducing concepts such as hedged items and hedging instruments. Kevin, if you just go to the next slide for me, please. We know that in the example that I've just given you, that there is a risk that we're trying to manage. That risk is the cash flow associated with the payment to the supplier for the piece of equipment. That in itself is the hedged item. We're trying to manage that risk. What we are using to manage that risk is a hedging instrument. And in our case, it was a forward contract. So the first step, some might say, some argue that it's all interrelated, that's not necessarily a deal breaker for today, would be that you need to designate what you are hedging and you need to document that formally. And that is a definite requirement, and your auditors and advisors will tell you that your documentation needs to be in place at the inception of a hedge, otherwise you will be in a bit of trouble, or you'll be in strife in terms of the effectiveness of the hedge. You can read on the slide what the requirements are, but the two I just want to call out would be the first two. The risk management strategy, we're going back again to the way in which we manage the risk. We've mentioned that today a number of times on the call. This is management saying, well, we often buy property, plant, and equipment from overseas suppliers, and we often get exposed to exchange rate differences. And our strategy, therefore, is to manage that risk by using, say, appropriate instruments. And I made that one up on the spot. Risk management objective, though, is a lot lower. That's the level where we start picking out the hedged item and the hedging instrument, and we sort of saying, how do they relate to each other? And you'll see that the rest of them follow all the way to the last point, which talks about the effectiveness requirements, and we'll touch on that in a second. Kevin, if you can go to the next slide, please. The other two, the red and the orange boxes, are really those type of items we're allowed to hedge. Now, already I've spoiled a little bit of this for you, because I told you that the payment to the supplier in 6 months' time is allowed to be hedged, so that's a hedged item. But the types of things we can hedge are, in my example, that was a firm commitment. We signed a contract, we are looking to make a payment in the future, highly probable forecasted transactions, and assets and liabilities that actually live on your balance sheet. And if you were interested, also a net investment in foreign operations, just to complete the picture. So those are the kind of exposures that we are allowed to hedge account under 9. Eligible hedging instruments really relate, big picture, to two things: derivatives. And it's a very common way of managing the risk: interest rate swaps, forward contracts, as we said, options, etc. The other one would also be, even if it's a non-derivative, if it's a financial asset or liability that is measured through P&L, so fair value through P&L. Because clearly what you want to do is ensure that there's an offsetting, or at least a mitigating impact of your hedging instrument to the position you're trying to hedge. And the last one is really just the effectiveness requirement. And you would probably not be surprised that if we want to effectively hedge an exposure, we need to know that what we're doing really counteracts, mitigates, or even eliminates the exposure we're facing. In our example, again, one would imagine that there's a very high correlation between the movements in the value of the forward exchange contract based on exchange rates and what we would think the payment, the exposure, how that would move. But it would be opposite. So the hedge effectiveness requirement is the let's call it the measure by which what you implement to measure the risk is effective in counteracting the risk that arises from the hedged item. The last slide I have, I won't dwell on. It's just that once we've worked out that we are able to hedge, sometimes you are, you do need to sort of call out what kind of hedging relationship you have. So obviously we have a hedged item and we have a hedging instrument. We put them in a hedged relationship. We do the documentation and we make sure that they're effective. There are only 3. And Kevin, for the next slide, please. Which is what I've just sort of explained. But the 3 hedging relationships would be net investment in foreign operation, a cash flow hedge, or a fair value hedge. And they are pretty self-explanatory. The one that I refer to is a cash flow hedge. And we would be ensuring that when we do our documentation, that the risk we're addressing is all to do with cash flow, etc. So what can I leave you with hedge accounting? Think about it like this. Hedge accounting should not be driving the way you manage your business. The way you manage your business and the way you manage your financial risks could be, if all the requirements are there and you feel that you're comfortable with the documentation requirements, the testing requirements, etc., it may then be quite an attractive option for you to consider whether hedge accounting fits into your hedge strategy, so that you get some of the benefits, if you like, of deferring or delaying or shall I say changing the usual requirements of accounting for fair value movements in your P&L and deferring that to another day to match when the exposure actually occurs. And with that, Kevin, back to you.
Thank you, Etienne. I must say, in 54 minutes, you and I have both managed to demystify virtually all the important bits of the financial instrument standards in IFRS. Let that be our parting gift for 2022 to the world at large. Thank you, Etienne, for that. I did appreciate it, and I hope you've enjoyed the session, everybody. I'll wrap up with an ending for 2022 in terms of our BDO resources. Just to actually bring your attention to the fact that we have put out our 2023 corporate reporting topics for webinars in 2023. They're up on the BDO website. You can start to register for those. I'll just run through them very quickly from top to bottom. We'll be starting on the 1st of February with what's hot and what's not in 2023. So we'll take a helicopter view of what's pretty much coming in the world of corporate reporting in the year ahead. Notice there won't be any webinar in January itself. The first one on the 1st of February is actually the January session. It's just going to be on the 1st of Feb. And then we'll get into a series of sustainability and ESG report, webinars, bearing in mind that this is relevant to corporate reporting. It is the new norm in corporate reporting. So please don't treat ESG and sustainability as something standalone from the accounting standards. They actually are one and the same now going forward. S1 and S2 are standards that are being issued by the standard setter, the IFRS standard setters, which will take us into March and April. And then we will kind of lead down to the middle of the year preparation for example, your 30 June 2023. That's our traditional May webinar where we kind of take another view of what's facing you in your June reporting. Be moving into some climate disclosures in June, and then back to lease accounting practices in July. That one there is for a letter, as one of our favorite topics, but it is true that lease accounting has never really gone away. In fact, it's becoming more and more complex in the 3rd and 4th years because it's a prospective standard that requires systems and processes to actually work. So we will be taking another look at that in our July session. On this slide, the latter part of the year, at the top of that slide, I've actually got a link to where you can find these webinars for 2023. And when you get there, you'll also find a link to the 2022 webinars, including the one we're doing today. And those ones, you can actually go and download any of the ones we've done this year, as well as in years past. It's available to download free of charge. 23rd of August, we'll be doing convertible notes again. Once again, something that's rearing ahead, deals and transactions and M&A are starting to happen again. So we're starting to see these instruments making a return. And then some other new topics that will introduce spring cleaning your balance sheet, tax effect accounting, and then business combinations, and the getting ready for 2023 December reporting periods in our November. So please go and register for those, and we'll be really happy to see you in 2023. Corporate Reporting Insights, this is a link just to our subscriptions page where you can find all our content as well as our insights. And at that point, I'll actually say, bringing it to an end, thank you, Etienne, for this and other webinars that you've been involved in. Etienne is celebrating his first full year at BDO, and I must say it's been a great opportunity to work with Etienne. Valuable contribution to the team. Really like having him in the team, and I certainly get a lot out of interacting with Etienne, and also our clients do. I'd also like to thank Aletta in her absence. You would have noticed that Aletta actually isn't on the webinar today. She's taken some well-deserved early Christmas break. But Aletta is really the glue that holds the IFRS and corporate reporting team together at BDO. So in her absence, I'd like to thank Aletta for everything she's done this year and continues to do for our team and BDO more broadly. On the screen, once again, if you want to get hold of any of the corporate reporting leaders around the country, we've got Melbourne, Perth, myself in Sydney with Etienne, and then Clark in Brisbane, and then Adelaide we've got Lindo, and I'd like to say that Lynn will actually be becoming a partner in Adelaide come January. So congratulations to Lynn, who will be becoming a partner of BDO come 1 January 2023. We're very happy and very proud of that too. So I'll leave you with that. Thank you very much. And Etienne, goodbye to you as well, and thank you for...
Yeah, I just wanted to, Kevin, you thanked everyone else, and I think we'd go amiss if we don't thank you for the contributions that you've delivered through the year as well. You know, very good to just debate issues with you, and you always bring a really good perspective to this. So thank you to you too, and to everyone on the on the call if you do celebrate Christmas. Merry Christmas to you. If you don't, enjoy the few days that you potentially get off during the festive season, and take care of yourselves, and we'll see you back in 2023.
Goodbye, everybody.